Hello everyone, welcome to this webinar on ITS, Portugal's new low-tax residency scheme. My name is Julian Benson. I'm a writer here at Your Overseas Home and I work with a particular focus on Portugal. I'm joined by Robin Thornton, a partner at Hoban Assets. Hoban is a leading financial services company with over 20,000 clients. Robin spends his day helping expats around the world plan their finances, and we're extremely excited to have him with us today. Robin, would you mind telling us a bit about yourself and how you spend your day-to-day?
Yes, hi, good afternoon to you, or good evening and good morning, wherever you are in the world, I guess. I'm going to correct you on one little point to begin with. The ITS scheme is actually applicable to any nationality, as long as you're residing in Portugal, but more to come on that later. So Hoban Assets, first of all, are a global wealth management company. We have been established for over 25 years now, British family, 500 plus employees, offices all over the world, and obviously one in Portugal in Bougainvillea Plaza in Valdelobo. And we look after about 20,000 clients across the globe. And we specialize in what I do is I'm a chartered financial planner, is particularly in the kind of cross-border movement of people and capital. So right money, right place, right time. So people perhaps moving to a new country, taking advantage of the benefits of that, and obviously avoiding the pitfalls as well. So we do a lot of that international tax planning. And the other side of the business, which is the global mobility solutions side, which I'm also a partner in, we deal with golden visas, getting people regular visas through lawyers, etc., to move and migrate to that country. So dependent on people's circumstances. Okay.
Oh, fantastic. Well, so today, as we were saying, we're going to be talking about the ITS scheme. I mean, as much as we want to focus on the sun and the sand when we get to moving to Portugal, we do also need to spend time preparing for what it would be to move our living abroad as well. We know it could be a complicated issue, and it's really good to have that opportunity to put your particular instance to someone.
So now you know all about us, so to speak. Let's move on to the ITS scheme. And this might sound a little bit low value, shall we say, but I'm just going to explain what ITS isn't. This is my explainer slide. It is not a visa. It is not a travel document. It is not a certificate of good standing. It's not a golden visa. You get where we're going here with this? It's not a right to visit, retire, study, go see your grandmother. It is none of those kind of things. It is, however, a special tax regime akin to, for example, one that is in Spain, which you've probably heard of, colloquially known as the Beckham Law. So this is a special tax regime. Now, in terms of a little bit of an explanation about NHR, you've probably heard of NHR. NHR was the non-habitual tax regime. It's been in place for many, many years in Portugal, and it typically attracted people with passive incomes. So that would be retirees, people with perhaps dividend payments, interest on various accounts, whatever it was. And it was very positive, drew in a lot of people into Portugal. However, politicians got involved, I guess, alongside pressures on particular housing, in some areas of, for example, the Algarve, Quinta del Lago, Valdelobo, Almansil. Basically you cannot buy a property down there, for less than €1 million. And it put pressure on parts of Cascais in the north and Lisbon. And of course, it's not great for the economy either, when sometimes these were second homes. It was also deemed not to be adding value to the economy. And the reason I'm going through this explainer is then you can kind of focus and you can understand what the new ITS, the incentivized tax regime, is. So NHR wasn't really long-term generating revenue. You could argue that people were spending their money in Portugal, so there was a claw on the the tax, the VAT, the IVA. And one of the big issues with Portugal generally is that it's had a loss of people for many, many years. Now, understandably, in 20, 30 years ago, because it's been moving from an agricultural based economy to try be a bit more service orientated, technology, innovation, things like that. There's actually quite a big oil base there as well, because a lot of drilling goes offshore. But they've been losing people. So basically want to attract people back. Now, ICE focuses on economic activity and high values, and I'll come on to that in a second. So basically, in the nicest possible way, they want people living in Portugal, earning money, preferably be from overseas. They're going to maybe tax you a little bit, but they're going to make it attractive to go there. And or there's these high value economic activities, which are effectively your kind of industries which you would expect, dentists, solicitors, CEOs of of companies. And it's a massive list, and I'll come on to that in a second. So the incentivized tax regime, it must be a high value activity, just reiterating that. So there is a long list, and I'm happy to email that list to anybody or hook up on a meeting, and I'll give you the contact details at the end. But quite frankly, it's such a massive list. I haven't worked out anybody that I know personally that doesn't have one of those jobs functions. So it is everything from farmers, which they're now in short supply, would you believe, to hotel managers. It's got a massive hospitality, business in Portugal itself, to the usual, lawyers and dentists and highly qualified professions, CEOs, directors of companies, so quite a long list. Or self-employed. Well, frankly, that means that you could be in one of those two camps. Self-employed is a little bit more difficult to be in, but it's quite easy to prove, and especially if you've got a business plan. Now, there are a couple of caveats. So you must be qualified. In fact, there are 3 caveats. I've only put one here, but you must be qualified to at least level 4 on the European qualifications framework. So that usually means you hold like a diploma. So for example, myself, I'm a chartered financial planner. I've got a diploma in investment advice. So it's either that or it's a long period of expertise and doing that profession, to qualify. And again, we can go into a bit more detail for that. But generally speaking, it's highly qualified professional people. It does last for 10 years. So it's exactly the same as the NHR, 10 years duration, which is very attractive. You must be a tax resident in Portugal. You are going there to live. And again, I'll come on to the process of that at the end, and I'll explain how you apply for this. Again, a little caveat, you can't have been in Portugal and lived in Portugal for 5 full tax years. And again, careful on that one. That's why you need to check with a good lawyer or ourselves, because the tax year in Portugal runs differently if you're coming from the UK. For example, tax year in Portugal runs from January to December. So you could potentially have 7 years if you work out the maths on that if you've previously lived there. Also, you can't have a career break of more than 6 months, and you'll lose your special tax status as well. That's really to stop people kind of applying for this, and then maybe going on a cruise around the world or whatever it is, or retiring to an island somewhere and retaining that tax regime from passive income. What do you get a tax exemption on? And again, a lot of this is down to legal speak. So I'm trying to cut through the legal speak, but basically you get a tax exemption if income from, for example, royalties or dividends are taxable at source. Now, a good example of that is if you get income from let's say a royalty or a dividend, which in the UK is taxable, but you don't pay any tax on it because perhaps it's under the personal allowance, or it's got some kind of special exemption. So kind of entrepreneurs and various structures allow dividends to be paid out if it's a real estate investment trust. So there's quite a few things like that which are very tax efficient for the UK. So if they are taxable, they're exempt in Portugal, so you don't pay anything on them. So that's potentially 0 and 0. Capital gains, and this is a big change which has been hidden into the kind of legislation, has been removed on all movable and immovable assets. Movable assets are things, typically financial, stocks, shares, anything that's, that can be moved anywhere in the world. And obviously movable is, and immovable is your properties. Now that's a big change, because before under NA, people will still have to pay 28% tax. So if you sold your house in the UK, your main house in the UK, for example, after moving to Portugal, you'd be paying HMRC, capital gains tax, 24%, it's just gone up, hasn't it? 24% now in the UK, and then you'd be paying Portugal an extra 4%. Well, that's all gone. Again, devil's in the detail. Each person's situation is difficult, and you need to take some advice on that. Okay, so The focus is on income tax, really, for most people. So the incentivized tax regime focuses on really two areas of income. Overseas income will be taxed at a maximum of 20%. Now, what that means is that if income is coming from Dubai, this is a picture of Dubai, where I used to live, it means that your income from there will be taxed at 20%. And that's a flat rate. There's no kind of allowances or different scenarios, and that's a flat rate. Domestic income would be taxed at 20%. Sorry, if I just take a step back, actually, what I haven't explained there is if your income from overseas is taxable in another country and it's less than 20%, you would only pay the lower amount. Now, there's not many places around the world, quite frankly. I'm thinking possibly Cyprus, some forms of income in Cyprus. So you would pay the lower amount. However, income derived internally in Portugal, domestic income, that would be taxed at a flat rate of 20%. So it's really attractive in terms of your overall tax position. However, what I see online all the time is people don't factor in one thing, and that's your social security. So social security in the UK would be your national insurance. In Spain, it's a social security for self-employed. It's like a progressive table. And in Portugal, it's 11% of your gross income. So for example, if you're earning 100,000 a year, yes, you're going to be paying, say, 20% income tax, but you've also got that 11,000 a year in terms of your social security. So it's very rough maths, this, but effectively you're looking at a 31% maximum tax rate, which is still attractive for a lot of countries. How do you get it? There's an application form there. Fill out your details on screen. I'm sure it's not as simple as that. You need to engage first of all and get the detail. I've given you a very rough guide here. It's a kind of a flavor, I suppose. So what we do at Holborn is we have an initial meeting with clients. We take some basic details and then we engage with a law firm, with yourselves, to get the nitty gritty and really make sure that everything is in order. Obviously, you need to move there. What another strange issue it is, perhaps, is you actually have to live in Portugal. So you need to obtain a visa, either a golden visa or one of the D series visas. I've put here 2 and 8 because those are the most suitable for most people who want to carry on working as a tax resident of Portugal. So 2 is the entrepreneur visa and 8 is the nomad visa, the digital nomad visa. Once you're there, you need an address. Again, sounds a bit daft. You need to move there, have an address, stay in country for more than 183 days so you become a tax resident. And then, one other thing there as well is make sure that depending on your type of visa that you've gone for, you maintain that minimum. So if you're doing this D series visa, the caveat to hold a D series visa is that you are a permanent resident, whereas a golden visa, you don't have to do that. It's your choice, so to speak. So you'll maintain the golden visa by doing, you only have to do 1 week in a year. And then you apply for IT. It sounds a little bit convoluted, doesn't it? So you are actually probably taking a little bit of a risk, but again, if you're using a good law firm, good financial advisors, you're mitigating that risk right down. And basically the lawyers will say, yeah, that's doable, that's not a problem, or yes, it is a problem. However, there is, route A, route or route. Okay, that's the end of a very quick through. Julian, I'm sure you've got some questions for me. If anybody would like to reach out for that list of job functions or book a consultation with me, you can grab the code from the screen there. You've got my email address. There's my WhatsApp number and phone number. I'm based here in southern Spain. And Julian, over to you.
Awesome. Robin, thank you so much. Well, actually, one of the first questions we've had in is straight into the detail, talking about dividends. So dividends in the UK are taxed at 8.75%. Would that mean that they'd have to pay the difference up to 20% as members of the ITS scheme?
No, you would pay nothing. It would be tax-free in Portugal. You'd pay your dividend tax in the UK and 0 in Portugal because it's
fantastic. Well, actually, so if there's any follow-ups on that answer, please do message them in the box on the right. I've got a couple of questions myself as well. So one of the things I wanted to ask really is, in its most simple terms, will the average person who qualifies for ITS be better off by relocating to Portugal and applying for this scheme than they would be than staying in their home country?
Okay, good question. Like all things, there's never a straight answer for that. It depends what your home country is. I used to live in Dubai and pay zero income tax, but it was very expensive to live there. There are taxable jurisdictions around the world. The UK is no longer, well, it's never really been tax friendly. But generally speaking, certainly the numbers that I've done and worked out for clients previously, if you're into the kind of 80,000 a year euros, we're talking brackets and upwards, yes, it's always going to be cheaper, basically because you're capping that income tax at 20%. Quite frankly, the more you earn, the more beneficial it would be to be in Portugal than, for example, where you've got a federal income tax and you've also got potentially state taxes in places like California. In fact, there's not many states that don't have a state tax in the US. Even if you're coming from Spain, you previously lived in Spain, I know, I pay my taxes here, it can be quite substantial. So generally speaking, yes, but it depends on your circumstances. And of course, it also depends how you spend it. I once used to say to members of my team that I want to pay a lot of tax. And they were looking at me very strangely going, what, why? Because it means I'm making a lot of money. So I'd love to be, turning over hundreds of thousands a year with new clients and new business and paying a lot in tax. Yes, I want to manage that tax, but it's also about the opportunity of that. So if somebody's got a business proposition or they are in one of those professions, can they duplicate that from their home country as a resident of Portugal? So there's the kind of soft, fluffy things that go on around the outside. Is there good infrastructure? Is there good communications? Is there networking? Can I sell this product? Can I buy that product? Can I move it freely around? Whatever that business is. Do you understand? It's like one thing about tax, but it's also about, can you still do that role?
So it's very much going to come down to your personal circumstances, but there's definitely a good reason to start investigating why this scheme might actually end up being better for you financially. We've got another question in from one of our viewers. It's a little detailed, so I will try and keep it slow and broken down. But it's a question about capital gains tax. They say, I'm selling a flat in the UK in order to buy a property in Madeira. Am I entitled for relief on the expenses I incurred buying the flat? I'm particularly thinking of air travel. I'm based in Berlin, so I had to fly into the UK a number of times in order to make the purchase.
Ooh, that's an interesting one. I don't think you would be able to do that and claim relief on that. It would be down to a tax lawyer in the UK. I'm presuming this is because you said flying in from Berlin. That is not the person's main residence in the UK. Because of course, if it's your main residence in the UK, there is no capital gains tax. So there's nothing to claim relief against. If it's a second home, you would only be able to claim relief on business expenses related to the sale of that property. So, travel, etc., doesn't come into it under normal circumstances.
Awesome, thanks so much. And so another question from a viewer. So is there a scenario where if you qualify for ITS and you fall into the highest tax bracket, you could still find ways to reduce your taxable income below the 20% tax bracket?
I guess there would be, but it probably needs some restructuring of your personal finances. Again, it depends on a bespoke basis. I'm thinking here is if somebody has a business in the UK or a lower tax jurisdiction where you can create dividends, as the previous respondent was talking about, dividends in the UK is on a sliding scale. So perhaps you could, rejig that, so to speak. So it's a difficult one to answer, but I wouldn't have thought there's a great deal of benefit in it unless, the sums are quite large. I mean, I'll give you a quick example. You could set up a structure through Cyprus, have a holding company there, get dividends from there. Taxes in Cyprus are relatively low in terms of dividends and payments. So that would reduce, some of your taxable liability. But again, bit of a complicated one, very much on an individual basis.
That sort of thing, which, yeah, it does sound like maybe following up in a call in the future is the way to go, because that sounds like it's very specific to that person's individual setup and circumstances.
Sure.
Well, so actually, one of the other questions I wanted to ask was, are there any reasons someone who qualifies for ITS would be better off by not applying for it? Are there other schemes about, or is it a case of probably keeping their income paid at home?
Again, it's almost like down to one of your initial questions. It depends on where they live now. So me personally, living in Portugal with an attractive tax regime where I can buy a nice bottle of red wine from the Del Douro for €8 or €10 and live a great lifestyle. I mean, at the end of the day, it's how you spend it, I think, is extremely attractive. You could go live in the British Virgin Islands if you've got the right qualification. You go move to Dubai, but it's extremely expensive and it's 50 degrees in the summer. So it's about lifestyle choice as well. And again, this is where we come down to the thoughts about how to spend it, as well as what your tax rate is.
Thing. So actually got another question here, which is asking, do you have to buy a property in Portugal or can you rent? Now, I assume this would probably be more about getting those residency schemes such as the D visa rather than golden visa. But
yeah, you can rent. It's very common. And again, the law firms that we deal with, they even have arrangements with agents. So what most people do, and again it's down to lifestyle choice, but perhaps they'll rent in Lisbon to start with, a small apartment, or or Porto or wherever, and that's their registered address, and that allows them then to apply for residency. And then usually when people have got a bit more time, a bit more patience, then looking to purchase a property or move to a different area.
Something else you mentioned during presentation was that you couldn't take a career break for more than 6 months. And at that point, what happens? Is it sort of you fall out of the ITS scheme and switch to a different tax system? Or
yes, yeah. So what would happen in that instance? And again, don't forget, put this into perspective. It's an awful long list of job functions, so you could change job functions. But what would happen is you'd fall out of that ITS scheme and it would end, and then the following tax year you would then go on to the normal progressive income tax tables. So again, very similar to most countries around the world, it's in bands, going up to the highest income tax band at 48%, which is the highest band. So it's progressive rates all the way up, plus your social security.
So actually that ties into another question. This might need to be the last one we take. But so one of our viewers is saying 20% plus 11% doesn't seem that attractive. Are there lower tax countries within Europe, so Cyprus, for instance, which would be a better place to move to for your finances?
Yeah, again, it depends on how your income is structured. So yes, there is. For example, going to Cyprus, that's got a separate tax regime. For example, pensions in Cyprus are only taxed at 5%, so it's really attractive for people. There are other benefits to Portugal. For example, cryptocurrency is not taxed if it's held for more than a year, so that's very attractive for people with large crypto wallets. It's attractive enough to be competitive against Spain, unless you can get onto the Beckham regime, the special tax regime it's called, which is the Beckham law, which is a flat 24%. So there are other schemes out there, but again, I hate to say it, sound like a broken record, depends on people's circumstances and how they've got their finances structured.
Well, thank you so much. I'm afraid that's probably going to be about as much time as we have today.